All right, thank you very much. So based on the previous presentation, we're trying to have back-to-back fun presentations. Obviously, the macro guys are enjoying themselves with all the bevy of opportunities created with the volatility out there. So as you can see with my first slide, my theme is to try and have fun. But for many, there are some people on this ride that obviously look like they're having fun. Typically, it's those people when you go to a theme park or a roller coaster that want to sit in the front seats. But you know, I draw your attention to the people sitting at the back, you know, the ones with their eyes closed. You know, I think those are the ones pretty much, unlike most people here that might be involved in the public markets, the markets that where you keep the score every day, liquid markets. I think, unfortunately, those are the people that are sitting and waiting for their year-end private market, mark-to-market statements. I'm sorry to say that they have their eyes closed and they're very nervous. And you know, what's happened in the public markets, unfortunately, is going to foreshadow what happens to a lot of people's private books. And so, when I started Wealhouse, I was trying to figure out, you know, how do you build a business model that can anticipate, predict, make money, protect money from change. And so, you know, right now, obviously, there's a lot of changes when it comes to interest rates for the first time in my career. And you know, if you ask my kids, you know, my 3 adult kids, what's the thing that they say Dad says is the most important thing other than my wife, their mother, and them, they would say it's interest rates. Obviously, starting a couple of years ago, as we heard from Mr. Price from Bridgewater yesterday, government spending became a little bit of an issue. And I think thanks to what happened in the UK just a few hours ago, there's a lot of politicians that perhaps have changed their mindset about how they're going to manage fiscal spending going forward. So we're back to, I think, a world where interest rates are truly the most important thing. And you know, we'll all say a little prayer that that Powell isn't channeling too much of his inner Volcker if we believe that there's a correlation between the height of the central bank chief and where rates could go. So at Wealhouse, because of these changes, I've seated 2 different teammates starting back a few years ago in anticipation that the world was going to get a little more volatile. On the left, you've got one of my colleagues named Justin Anise, and on the right is Andrew Labad, and they're sitting with my teammate Emily Newman over there if you want to learn more about what they do. But the simple premise is, so Justin is a long-short equity manager, and then Andrew is a long-short credit manager. And so they've been having lots of fun this year for our clients and with our team because the world's become very volatile. And as a result of that, you know, Justin is up just around 30% year to date, which is quite impressive. And then Andrew is doing heroically in the very challenging, worst fixed income market I've seen in my career, where you know the indices are down high teens. He's still up around mid-single digits. And that's on top of last year, where Justin was up 47% and Andrew was up 10%. So, you know, so they're doing something right. As it says in business, when you're looking to add people to your team or hire, you know, you want to hire people that are smart yourself, and obviously I've at least become good at doing that. You know, when I look back at my career, there has been times where, you know, the way I've made money, that I had the most success making money, is generally finding small companies that become bigger companies, and then being a contrarian, you know, and taking the road less traveled by. And our idea today, you know, the idea that I've put forth today for you, meets both of these checklist items. And, you know, I think we'll all have fun when we talk about that. But I have a little trivia question. RBC stands for Royal Bank. For our American friends who might not know, Royal Bank is the largest company in this country because there's, you know, in their world, the banking system is no longer the largest company. Obviously, the tech companies are the largest companies in their world. But, you know, there's a quote from Warren Buffett that I like that says, you know, if a money manager stands before you and he says that as he gathers more assets under management, it won't impact his performance, stand back, his nose is about to grow, right? So one thing about Wealhouse, one thing about I really respect with regards to Justin and Andrew is that they're not looking to be the largest managers in the world. They're not looking to be the next Bridgewater, the next Royal Bank. They want to be the best money managers. And so with that said, they're very, very discriminate with their capacity, and they're very, I I respect their patience and how they're growing their business. So the answer to who's the largest shareholder of Royal Bank before you is Royal Bank, right? And it's kind of a little eerie when you think about it, when you look at the other Canadian banks that all own each other. And if you go and you have time to kill this weekend with your Bloomberg device and you want to see, you'll see all these banks, they kind of own each other. It's a little reminiscent of what happened in Japan. And then the other owners are the passives, the ETFs, right? The exchange traded funds like Vanguard. And then BlackRock would show up as number 9, which is not on this list here. But it's important for what, how Andrew and Justin and how we at Wealhouse are trying to design our products. So we noticed that, more and more money is run by fewer and fewer firms as I've played out my career. And so, Big Bad, there's a quote from Bruce Flatt from Big Bad Brookfield Asset Management, who I respect immensely. And the simple idea is that there's lots of inefficiencies within small cap companies, right? And so we think that, and obviously if you're trying to be an active manager, you're trying to find inefficiencies. Otherwise, you should just use an ETF. And so Brookfield, has shown that. We started this fund called Voyager in 2018 when we started to note that, for the first time in my career, I would see private, illiquid businesses trading at premiums to public liquid companies, right? And that was one of the unintended consequences, I think, of quantitative easing. And it just makes no sense to me that a public company, which, is liquid, where we have the ability, if I give you an idea today and I change my mind, buyer beware, I can get out of it. But if I go into a private business and I call someone to get my money back, too bad, so sad, you're not getting your money back. So it's interesting that, since we launched Voyager in 2018, here's a smattering, a sample of some of the companies that have been taken over within the Voyager Small Cap Fund. And our idea today, and I'm going to present, we think is a very ripe takeover candidate. And what's interesting you'll see here is that some of the people that are buying our assets are actually the private equity people. So the private equity people, like Mr. Flatt recognized, are saying they see better opportunities within the public markets when technically they've been giving money in some ways to go invest in the private domain. So, I was at dinner last night and someone asked me, where are we seeing opportunities? And, obviously as a previous macro panel, scared us all. It's very hard right now. It's very dicey. And so we're trying to control what we can control. So one way in my past, what I like to try and find, simple, economics 101, is find industries or businesses where demand is either flat or going up into a recessionary environment, or supply is flat to going down. And so we say, those kind of situations are the ones in these market sell-offs that are happening every second hour, let alone every second day or second week, that we want to buy. And then from a shorting standpoint, we would look to hedge or protect our investments in industries and sectors where we see supply going up and demand going down. Remember, it's become obvious to everyone, Mr. Chair Powell has got a mission to destroy demand as much as he can, because really it's pretty hard for him to have any material impact on supply dynamics. And so as we sit here today, our idea is in an industry, in a business, where there really hasn't been all that much supply growth. And it's an idea that actually was negatively impacted in a significant way during COVID. And so it's still in a rebound state. I'm not trying to be naive. I recognize that the recession is coming and that there will be some headwinds, but they're still in a place to recover. So the idea today is Cedar Fair. So Cedar Fair is F-U-N is the ticker symbol, fun, right? So that was the theme of the idea, to try and have some fun today. And so this idea, it's an amusement park business that is headquartered in Sandusky, Ohio. And you can see one of the ways they try to manage some of the risks is being diversified across different jurisdictions in North America. And then they have one asset here north of Toronto in Vaughan, Ontario, called Canada's Wonderland. And it's interesting. I think, always looking for ideas where people don't understand the opportunity. And Canadians have trouble understanding this business because it's obviously hard to have done due diligence and gone to all these different discrete assets. And at the same time, I think Americans, which is the predominant makeup of their shareholder base, don't necessarily understand how fast and how much Vaughan has grown. And so, as I said before, I think small caps are much cheaper by and large than large caps. And as you can see here, in the leisure business, Cedar Fair trades at a significant discount to other type of leisure unique assets like Disney or Vail, right? So from a multiple. So we think there's opportunity for that gap to close as the business gets bigger and attracts more of a shareholder base, as their business fundamentals continue to improve, as things normalize post-COVID. And we also think it's much cheaper than some of the larger cap assets that you can see in the leisure industry, like Netflix and Roblox. We think is the perfect example of the unintended consequences of quantitative easing and access to free money, because not trying to be negative, but all their financials metrics are negative. And so one thing that we like, as I said before, is that there's lots of takeover activity in this space. When you study the history of this industry, private equity has its hands all over it. And so going back to 2019, one way we tried to figure out what the upside and downside valuations might be for this asset or set of assets is that Merlin was taken out by Blackstone in the UK, Merlin Entertainment. They own Legoland, for example, and that was by Blackstone. And I put a little note there for the Canadians in the room. You're technically already a shareholder in the theme park business because CPP, Canadian Pension Plan, is one of the LPs or partners with Blackstone on that. And then Park Reunidas from Spain was also taken out by private equity. But simply put, if you just take the valuations that were used in those two recent transactions and apply them to the fundamentals, which are improving once again for Cedar Fair, you come up with a valuation upside of mid-30s to mid-70s. Because since I did these slides, Cedar Fair is just tipped below 2.2 billion market cap and below $40 a share, whereas it was in the low 40s when I submitted these slides to our friends at C4K. But on that, with regards to Cedar Fair, it's even more powerful. I typically don't like to buy or make the essence of an investment thesis around takeout potential. But Cedar Fair, which has incredibly unique assets, once again, and I'll continue to talk about that, what's interesting about them, this year, they got a 60, then a bid from SeaWorld, one of their competitors or peers, and then then the bid was bumped up to 62, and it was rejected by the board. Going back pre-2019, another one of their peers, Six Flags, made a takeover offer at $70 a share versus, I said today, where it's trading around 39. So we think, in a way, there's a bit of a margin of safety or a put on this business. As we do enter a recession, it's obviously a highly sought-after set of assets. So, ideally, it's pretty hard this year in many ways to find charts that go up and to the right. So I decided to have some fun and put this one up in front of you. And as I said, when you study the history of this industry, of this business, it's been a very recession-resilient type of industry. And so I think that this trend can continue. But what's interesting is when I went to their head offices in Sandusky, Ohio, between Toledo and Cleveland, their first asset, Cedar Fair, which is over 800 acres right on the water, is a beautiful asset, and it was started in 1870, right? So not exactly a new digital streaming type of business, but it's stood the test of time, as evidenced by the fact that there's not too many businesses I've met that have been through two pandemics, right? So it was actually around in 1918 when there was a pandemic, and it had a second go at it back in 2020. So they're obviously experts when it comes to pandemics. They've been through multiple world wars and then multiple recessions. So the management team, the business itself, has a lot of experience navigating, controlling what they control in these cycles. And one thing that really impresses me or stood out this year is when you look at these stats, I draw your attention to the second line. Attendance, because of COVID disruptions, in particular, Canada, we were a little more conservative than our American friends when it came to opening up leisure facilities. Attendance has not even come close to recovering to what it was pre-COVID. Whereas when you look at the in-park per capita spending, it's gone through the moon. And so therefore we think that as attendance continues to improve, you're going to see substantial upside still in revenue and free cash flow potential from the business. So C4K, the great organization it is, was founded in 2014, not 1870. I know Kyle and Evan are looking a little older these days, but not that old. And the point being that you have, when you want to build a park, you need a lot of labor, right? And so minimum wage in Ontario to build Canada's Wonderland, for example, was $11 in 2014, versus now it's $15.50. So if you want to have the tradespeople to outfit a park, it's more expensive. From an entertainment competitive business standpoint, they in many ways they compete for the leisure dollar. So NHL, which is the most popular sport in Canada, you have salary cap's gone from $69 million to $82.5 million today, and so we think the replacement value, this argues that it's a lot higher than where the assets are today. And so, back in 2006, Cedar Fair paid CBS $1.24 billion for the asset, and by our math, by our analysis, we think that basically, is understated. One reason that's understated is because the physical world, as I said before, has become less and less important as the world's digitized, and too much capital on the back of QE has been allocated to the digitization and forgot about things that are important. So if you want to build a park, you want to build a roller coaster, obviously you need steel. And so lots of the physical aspects, so once again, we've seen the supply go down, and that means prices go up. And so, when you want to buy a roller coaster now, you're going to have to pay a lot more because steel costs more. And then the other asset we think is precious to them is their land. So this is a map. My PowerPoint skills aren't good enough to draw in a little line, around the park, but they're right in the middle, that rectangular area. You can see the park and the big parking lot. To pave that parking lot would be a little more expensive than 1981 when it was opened, because obviously oil prices are a little higher. And but if you can go back in history and you think about where they're located, it was surrounded by farmland. And it's not to be negative with management. When I went to meet them, I pointed out that south of the park is a new subway line in Vaughan. They weren't even fully aware of that. And so over time, we think that this piece of property will become more and more valuable as land attracts more and more people and it densifies. And so this is a hidden asset that we think that the property has, on top of being next to it originally was built because it's next to the major 400 series highways. So from a competitive standpoint, a family of four would cost $574 to get seasons pass. So not only 7 hours a day, but every time you want to go back. If you wanted to go buy mid-level seats for the Blue Jays, it would cost you $600. If you wanted to do that for the Raptors, which thankfully beat Cleveland last night, it'd be $800. And then if you wanted it for the Leafs, you want to sit in the Reds at the Leafs, that would be $1,200. And so imagine if the Leafs actually made it to the second round of playoffs, like my Montreal Canadiens did 2 years ago when they beat them in Game 7. Not to take any shots at my friends from Toronto. But generally speaking, we think as we head to a recession, if people have to squeeze their budgets, they're likely to dial back their spending on some of those more expensive choices. And so Cedar Fair, again, it's had a long track record of growing its revenues. And one thing that we like about this chart is that they still haven't, as I said, when I talk to management team, they haven't had the ability to see their group business improve, right? So Wealhouse is in this office. This office tower is full in this room, but generally there's more people in this room that I'd almost be willing to bet than the rest of the office building combined right now. And so we at Wealhouse, we've been doing lots of outings, lots of corporate things to build bonding with our team as there's more of a hybrid work model. And so I think places like Cedar Entertainment will do better and better. And so, and as well, they're growing additional revenue streams. So, for example, like when my kids grew up, I coached their soccer and their hockey teams. And first thing I would say to a manager at the beginning of every season is, let's find somewhere to have fun. Let's build team sportsmanship and all that thing. And so they're investing with cities to go into joint ventures where they can build like tournament facilities for baseball and soccer and volleyball close by. And this will drive ancillary and extra revenue into their hotels, into their campgrounds, into their parks that are located on their excess land. And so we think this is a more recession-resistant business when you go back to 2008, which was the biggest recession of my career. And so we think that, and you'll see that that this industry rebounded stronger. And the other thing is, obviously everyone likes recurring revenue businesses. You've seen multiples of companies over time in my career that have their multiples expand as recurring revenues go up. And so, as you can see in this chart, you know, they have gone from, they had set a record 3.2 million passes sold in 2022, which is 20% higher than what they did in 2019. And, you know, so this means that this chart goes up, and we think it could lead to multiple expansion, as now they're over 60% of their sales are coming from season passes. And so subscriptions often, as I said before, are helpful to improve the outlook for businesses. You know, and I draw your attention to Disney, which has obviously done the streaming business, and then you've got the Vail ski passes that have helped their multiple expand. And also, there's lots of risks. Weather, they managed by diversifying. You know, and then one risk was debt. You know, they had to take on extra debt. The good news is they didn't have to issue equity during COVID, but they took on extra debt. But to speak to the power of the hidden value of their land portfolio, they sold over 1 million acres for over $3 million to the largest industrial REIT, Prologis, earlier this year. And the good news from that, we don't think is reflected in the stock yet, is that's enabled them to reinstitute a dividend, and they have the ability to grow that dividend over time and to put in place a buyback. And so, you know, in summary, we think it sells at a significant discount. There's meaningful upside for the stock. If it, you know, goes down, we'll continue to build our position. And, you know, and they have lots of opportunities to continue to grow. And, you know, there's just huge barriers to entry for this business. You know, right now, to get a property zoned, to get a property permitted, you know, imagine, you know, who would want a bunch of screaming kids on a roller coaster anywhere near where they live? So hence, a park would have to be built. So they've got first mover advantage that we think is significant competitive advantage for this franchise and set of franchises going forward. And, you know, over time, they've paid out lots of dividends, they've compounded their equity, and, you know, there is a short interest as people are nervous still about COVID impacts. And you know, but we think this business, you know, based on my discussions and my visits with them in Sandusky is great. And an evidence that they have strong pricing power, they have strong discipline. Wealhouse wanted to do something nice for Capitalize for Kids, and so we wanted to buy some season passes. And I phoned them up to buy 100 season passes, see if they would give us a group discount, you know, for the kids. And what did Wonderland tell me? No. So we got to pay face value. So the good news is we will do that in order to support the kids, because we want the kids to have fun. And just quick thanks to my colleague, Kaylee. It's her birthday today, for helping me with the slides. And thank you very much, everyone.